China's rise as a global economic powerhouse has been accompanied by its emergence as a major lender to developing countries. However, there is growing concern that China's lending practices are turning it into a global credit mafia, trapping nations in a cycle of debt and exerting undue influence over their political and economic affairs. In recent years, China has rapidly increased its lending to developing countries, surpassing the International Monetary Fund or IMF in emergency financing. Alone in 2022, China provided $40.5 billion in loans to distressed countries, compared to the IMF's $68.6 billion. Its outstanding claim of over 5% of global GDP demonstrates the scale of its lending activities. China provided 128 rescue loans in 22 countries from 2008 to 2022, according to researchers from the United States-based research lab ADVATA, the World Bank, Harvard Kennedy School, and the Kiel Institute for the World Economy. The loans were provided after countries struggled to repay their debts from the Belt and Road Initiative, an infrastructure megaproject that Chinese leader Xi Jinping once called the project of the century. China's Belt and Road Initiative, or BRI, is a key component of its strategy to enhance its global standing and shape the geopolitical landscape. The BRI aims to build infrastructure networks, promote trade and economic cooperation, and foster connectivity across Asia, Africa, and Europe. China's lending practices have come under scrutiny due to their lack of transparency and exploitative nature. Unlike traditional lenders, China's loans often come with unfavorable terms and conditions, burdening borrower countries with exorbitant interest rates and restrictive repayment schedules. This puts immense strain on the economies of these nations, diverting funds from essential sectors like education, healthcare, and infrastructure development. China's debt diplomacy is exemplified by the notorious debt trap phenomenon. Under the guise of infrastructure development, China strategically targets underdeveloped countries, offering attractive loans and manipulating their political leadership. Once the initial projects are secured, the debt burden begins to accumulate, forcing nations into a state of dependency on China. Zambia's experience serves as a stark example, where interest payments consumed resources earmarked for critical social services and eventually led to a default. Over the past 2 decades, Zambia has borrowed billions of dollars from Chinese state-owned banks to build its infrastructure. The loans did improve Zambia's economy, but as interest payments piled up, Zambia had to cut spending on healthcare, social services, and farming subsidies. In the past, under such circumstances, big government lenders such as the United States, Japan, and France would work out deals to forgive some debt, with each lender disclosing clearly what they were owed and on what terms so no one would feel cheated. But China didn't play by those rules. It refused at first to even join in multinational talks, negotiating separately with Zambia and insisting on confidentiality that barred the country from telling non-Chinese lenders the terms of the loans and whether China had devised a way of muscling to the front of the repayment line. China's reluctance to forgive debt and its opaque lending practices exacerbate the situation. The lack of transparency regarding loan terms, conditions, and amounts makes it difficult for other lenders and the international community to provide effective assistance. This secrecy also enables China to prioritize its own interests, placing itself at the forefront of repayment queues by requiring borrowers to establish hidden escrow accounts. The consequences of China's lending practices are dire for borrower countries. Many nations are experiencing dwindling foreign currency reserves, jeopardizing their ability to pay for essential imports such as food and fuel. Countries like Pakistan, Ethiopia, and Mongolia have only a few months left before their foreign cash reserves are depleted. This leaves them vulnerable to further economic distress and potential political upheaval. China's loans to countries with geopolitical significance or abundant natural resources raise concerns about the potential for coercive leverage. By extending loans to countries like Pakistan and Sri Lanka, which are situated in India's immediate neighborhood, China gains influence over critical regions. The fear is that China may use its lending power to manipulate political decisions or gain control over strategic assets. The international community, led by major lenders such as the United States, must address the challenges posed by China's debt diplomacy. Multilateral institutions like the IMF should work towards establishing clear guidelines and procedures for debt relief, ensuring transparency and protecting borrower nations from falling into the Chinese debt trap. Cooperation among lenders is crucial to prevent further defaults and alleviate the burden on debtor countries. The United States has been actively engaged in addressing China's expanding influence as a global lender and has taken a number of measures to counter its influence. The United States is actively engaging with borrowing countries to raise awareness of the potential risks associated with overborrowing from China. It's also seeking to provide viable alternatives to Chinese financing by promoting its own development initiatives. For example, the United States government passed the Better Utilization of Investment Leading to Development or BUILD Act, which created the United States Development Finance Corporation, or DFC. The DFC aims to mobilize private sector investment in developing countries and provide an alternative to Chinese loans. The United States has also taken legislative measures to address China's lending practices. For example, American Congress passed the Better Use of Investments Leading to Development Act and the Electrification of Africa Act, which provide a framework for investment and promote transparency in foreign aid programs. China's rapid expansion as a global creditor raises concerns about its exploitation of developing nations through opaque lending practices and the establishment of a debt trap. The lack of transparency and unwillingness to provide debt relief exacerbate the financial vulnerabilities of borrower countries, leading to potential economic and political crises. Addressing this issue requires concerted efforts from the international community to establish fair and transparent lending practices and protect the interests of developing nations. Thank you for watching this video to the end. Subscribe to the channel and write your opinion in the comments.